In this lecture, we're going to discuss cash budgets. First of all, let's understand why cash budgeting is just so important for managers. Well, if you think about it, profits don't necessarily mean cash. You may have a profitable company, but that doesn't mean you've collected cash yet. Take, for example, if you had a yard service company. You go around, you cut people's grass, take care of their yard, and then you bill them. They haven't paid you yet you have employees that want to get paid. If you don't have the cash to pay those employees, you could be in trouble. So it's a timing situation. Cash budgeting helps ensure that you have the cash when you need it. If you're not sure that cash budgeting is important, just consider this. A profitable company may go out of business if they don't have cash when they need it. Just to remind you where the cash budget finds itself on the master budget. The cash budget is one of the financial budgets. To understand cash budgets, we're going to work one of the problems that we have in our textbook. If you look in the back of the textbook, you'll find problem P69B, Ivan's Restaurant Supply. So here's Ivan's Restaurant Supply's information, and we see there's a lot of information coming in, and all this information that we have that's provided for us needs to be used in the cash budget. However, just keep in mind that you only use some of it in each part of the budget. So let's go ahead and look at the budget itself, and keep in mind we're going to be pulling information from the information provided for us and this given information for the problem. So first of all, let's understand what a cash budget means. It means you're going to look at the timing of the cash that comes in. They call that the cash collection budget. And then you're going to look at the timing of the cash going out. They call that a cash payment budget. We have a cash payment budget for the direct materials and for the operating expenses. I went ahead and fixed the name there. So you have the cash coming in, and then the other side of the coin, the cash going out, and then you bring it all together in a combined cash budget where you compare cash coming in and cash going out to make sure that you have enough. So the cash collection budget, let's focus on that first. If we look at the homework information, we see the information for the problem. We see that there's some sales information provided. And so we want to look at the sales that we have and see when the cash is going to come in from those sales. So what I did is I just took that information and put it over here so it'd be easier to see. These are the sales that we have for each month. Now remember, just because you have a sale doesn't mean you've collected the cash. So Ivan will make sales to the restaurants. Ivan will provide supplies to the restaurants, but Ivan will then invoice the restaurant and wait for them to pay. So the sales work like this. This is given in the problem. Cash sales are 70%, meaning that in December there were $54,000 worth of sales. 70% comes in as cash right on the spot. Then the credit sales are 30%. So how is that 30% credit sales going to come in? So the problem tells us that 10% is going to come in during that exact same month, and then the rest of it is going to come in the next month. I guess they have a 30-day situation for their customers to pay them. Now keep in mind this is completely based on what's happening in the business. So every business will be different how this is set up. So you have to understand how your business is set up. But this is the one we're using for this problem. So first thing, I put the cash sales in. Now notice this is for the months January and February. However, I added in the gray areas, I added December and March. The only reason I did that is so you could follow along with the movement of the cash. It's not part of the problem itself for you to provide that in the answer. I just want you to see where the money is moving around, and some of the money moves around in December and some of the cash moves around in March. So I'll put those there so you could see them. The cash sales are 70%, so we just take 70% of December, and that's how much cash went to them in December. 70% in January and February from their total sales. Then we have the credit sales. So the credit sales are 30% of the total sales. So I just put them over here just so you could see it. 30% of December, 30% of January, and 30% of February. However, notice that of that 30%, 10% comes in the month in which they made the sale. So of this credit sale amount of $16,200, 10% is going to come in that same month. So the credit sale was made in December, 10% will come in December. Then the next month, the credit sale of $16,200, 90% will come the next month. So we can start to see the timing and what we're getting at. Even though the sale was made in December and it shows up as December part of the December profits, all of that cash wasn't received. So again, I just put this information in the schedule so that we could follow along for December, but we don't really need this for a report that's only really supposed to cover January and February. But it is good to see why this is only $14,580. Even though it was made in December, we collected it in January because of the terms of the sale. Let's look at January. Notice for January, 10% of the sales that were made, the credit sales that were made in January, so that's $18,000 is 30% of the $60,000, and then 10% of that is collected in January as cash, and the other 90% is collected in February. And the same with February. 10% will be collected in February, and then the rest will be collected in March. For the quarter, we just add up January, well, it's not for the quarter, for the first 2 months. Let's change that to the first 2 months. For the first 2 months, we noticed that there's only January and February included. We didn't include December. The problem doesn't want us to put December in the answer. I'm just putting December and March here so we can follow the flow of the money. And if we look at the total cash collections, we can see what we collected. Even though my January sales are $60,000, I'm only going to get $58,380 in cash. That shortage of a few $1,000s, is that going to hurt us or not? Well, we don't know. We only know what's coming in. We need to look at what's going out too. So there's 2 things we have to pay for: direct materials and then some of our operating expenses. So all of this information is provided in the problem. So it's all provided in this area B and C, D and E. So keep in mind this information here is now going to be used in the next payment schedules. However, also keep in mind we're only going to focus on the material purchases at this point. So really we only need to look at part B. So I just put the purchases here. We might make the purchase in January, but we're only going to pay for 40% in the month of the purchase and then the rest in the next month. So we might order something that comes in, we get a bill for it, we pay it. Well, sometimes the bill isn't due for 30 days, so we're not going to pay it till next month. So that's why we don't pay for everything in the same month. So again, this is more of an understanding that the income statement or the profit statement is different from the timing of when the cash is going to be needed or come in. So we're looking at the timing right now. So December purchases, it says 40% will be of that $23,000 is going to be paid in the month. So 40% is paid in December, 60% is paid in January. So 40% of $23,000 is $9,200, and then 60% of the $23,000 is $13,800. So the same thing for January. We're going to need 40% and then 60% the next month, and then February we need 40% and then 60% in March. And again, I included March just so you could see the flow of the cash. Even though it's not part of those 2 months, I want it to be part of the flow. And then finally we get the total that we need to pay for our purchases in January, the total we need in February. So we see how much money is coming in, we see how much money is going out. But that's not all the money that's going out. We also have other payments that we need to make as part of a business. The operating expenses are provided here. We have sales commissions, we have salaries for our sales employees, we have rent, and we have depreciation, and then we have to pay taxes. So this information is all going to be part of what we need to put into the timing of the cash. Let's start with the variable expenses. So we know commissions are variable expenses because A variable expense is an expense that increases with the more activity. So the more sales we have, the more the variable expenses are. Remember, it's a volume situation. In other words, volume of sales. The more sales we have, the more commissions we have. Therefore, it varies by volume. So the commissions are paid half in the month of purchase. So if they make a sale, that's half of that month, and then half the next month. So they don't pay the commissions all at once, probably just in case some of their sales don't come through. So the calculation is 15% of sales. So if I go to my sales, 54,000 for December, I take 15% of that, but I only pay half in December. So 15% is 8,100, and then I pay half in December, so I'll need half of the cash for December and half in January. So I'll put December there so you could see that, and then I put and you can also see that some of this cash needs in January come from last month. January is 60,000 in sales times 15%, that's 9,000, and then you just take that and you multiply it in half, by 0.5, and you get that you need 4,500 in cash for January's commissions and 45 in February, and then February's commissions, 15% of the February sales, take half of that, and then we see how much our total variable expenses are going to be, or we expect them to be, for January and February. Then we have our fixed expenses, which are expenses that you have to pay whether or not you made any sales at all. So of course we have salaries, and the salaries are paid half in the current month and half the next month. So they provided this information. This is the salaries that they have for December, January, and February as expected. So we're going to pay half of that in the month of December and half in the next month. Half in January, half in February. The rent is provided, and then the taxes are also provided. So let's put that information in. So I put the salaries in, 7,000 times 1/2. Half is paid in December, half is paid in January. This is because their pay periods probably don't fall within the month. You might get owed 7,000, but you might have a 2-week pay period, and the payment doesn't come until after the month is over. For HR, we understand that. Okay, so then the rent is due, and that's not anything. That's given, $2,900 a month, given. And now keep in mind the importance of understanding the payment timing. We don't have to worry about moving this to the next month or whatever. Our landlord, or whoever that is, wants the payment in the same exact month as they are owed the rent. So the $2,900 is due in January and February. Taxes are usually due and paid at certain points in time during the year. Even though you might accrue taxes throughout the year, you might owe taxes because you make sales, you don't submit those, or they call it remit the taxes to the government each and every day. You remit them at certain points. Our taxes are due in January, and this $13,000 for taxes was provided in the given information, and it says in there it's due in January. No taxes were due in February, so we don't need any cash in February for taxes. Notice I don't include depreciation in the fixed expenses. Why is that? Well, the reason we don't include depreciation is because it's not a cash thing. Depreciation is the allocation of the cost over time, but you don't send that cost away to anybody. It's like if something loses value, you don't write a check to somebody because something lost value. All right, so because depreciation, there's no cash involved, this is a cash payment schedule. We don't need cash to pay for depreciation. That's purely an accounting entry for depreciation. It's not a cash entry. It's not cash needed. So just leave it out altogether. And then we have our total cash needs for each month. Now let's put this together. We have cash coming in with the cash collection budget. We have cash going out with cash payment budgets for material and operating expenses. Let's put them together in a combined budget to see if there's any months where we fall short. We'll start with the January beginning cash. Now this was provided. We would have got this from our balance sheet in December, but we don't have a balance sheet for December in this problem, so they tell us specifically, it's given in the problem, cash balance at the beginning of January equals $24,000. So this is given to us. So we just put that in. Here's our starting point. Then we say, well, how much cash did we collect? we collected $58,380. I would say we plan to collect $58,380. I got that straight from your cash collection budget, $58,380. I drop it here, and then we can see that we expect to have available in January $82,380. That's what we expect to have in cash. Now let's look at what we need in January. We expect to need $22,000 for materials. I got that from the cash payment budget for materials, and $31,950 for operations. So I'm just putting that here to see if I have enough cash coming in versus cash payments. And then I just combine these two to see, well, this is coming in, this is a payment. How much cash do I expect to end the month with? So that's my starting point. Now again, I just go get my cash coming in. I put that for February, my cash going out, expected cash for payments for material, expected cash for payments for operating expenses, and then I'll see the difference. I expect to end the 2-month period of January, February with $50,320. So that's where I expect to end. So I'm going to put that here. That's my expecting ending point for the 2-month period. Whatever I end with in February is what I end the 2 months with. Whatever I begin the 2 months with is what I put here. So since I begin January with $24,000, I begin the 2-month period with $24,000. Now I add up these two to see how much cash I bring in for both January and February. So I'm bringing in those two added up, and then if I just take all of this cash, the $24,000 and the $124,220, that means I expect to have available to me $148,220. Then I'm just going to add up what I need for materials, add up what I need for operating expenses, and I see total I'm going to need $97,900. That means my ending cash, if I take the $148,220 minus the $97,900, will be $50,320. So to end the cash budget discussion, cash budgeting is really just about timing. We know our profits are going to be, or we expect them to be, but we know we will not get all that cash from profits at once. It's going to come in at different times. Since the timing of cash coming in and the timing of cash needs are different from the profits in the company, then we need to figure out if that timing is going to be off. This allows us to see if the timing is going to be off. Like I said before, you can have a profitable company, but if you don't have the cash to pay them because of the timing, the salaries and the vendors and the suppliers, then you could actually go out of business with a profitable company. So it's important that managers understand cash timing.